Okay, well, I wanted to welcome everyone here today. I'm Allison Kelly, the Director of Communications for Grow America. And before we get started on the webinar, I'm going to run through some quick housekeeping items. First, just to let you all know that the webinar will be recorded and emailed to you following the session. And second, we just wanted to let you know that we'd encourage you to engage with us in the chat and question and answers during the presentation. Our team will be monitoring it closely and we'll make sure that all of your questions are answered. We understand that running a business can be challenging, especially in uncertain times, and that's why we've put together this webinar to provide some insights, practical advice that you can apply immediately to your day-to-day. So let's get started. Here, I'll pass it over to my colleague, Brian Doxford.
Thank you, Allison, and thank you everyone who decided to carve out time on a busy day to join us. I'm one, excited, and two, honored that you would spend time with us. I will kick us off. And as you see the agenda on the screen, your first thought might be, wow, this looks a little bit light, but I want to give you a promise that while it does look light, the agenda covers topics that are critically important. So ready or not, let's get going. So let me go personal just to get us started. As people, we check our health. And we usually do that with some sort of a professional. And when we work with that professional, they look at things like our height, they look at our weight, they check our vision, they check our hearing, which I'm currently losing my hearing. They check things like our blood pressure and our heart rate by way of our pulse. They check our temperature and they check our respiratory rate. And then they'll explore our medical history, what's happened in our family, things that are common or maybe not common. They'll send us through a series of screenings and tests are conducted. So just like these checkups are needed as humans, businesses need them too. And we can rattle off from memory, just like I just did, all the different ways in which we proceed with and receive our own personal checkups. But what about our businesses? What should we measure? And why does it even matter to measure some of these things? I'm going to answer those questions today. And if helpful to know, just again, to go personal for one more minute, at Grow America, I help run a company within Grow America called the Grow America Fund. And we're a small business. We don't do the same things as all of you on the phone today, but we run and operate a business. And so the resources and the tips that will be shared today, we use them and they work. And I'm going to jump right into the details. To frame up how today will go, we're going to talk about several financial health areas. And we're going to start with what I think is perhaps the most important one. Frankly, cash flow is vital to the success of your business. And when I say cash flow, I'm talking about, to speak with my hands, money that is coming in and then money that is going out of your business. As we advance through the slides, again, since this is the first time that you see one of the health areas, you'll also see what to track and red flags. So for anyone that's out there taking notes today, what you're seeing on the screen will be consistent throughout. So to follow now the flow of our cash, there's a handful of things that you absolutely must track, and many of those things are highlighted on the screen. So it's essential to track money coming in by way of sales, your payments from customers, maybe a refund from a vendor. Again, on the other side, the money coming out, right? What are the bills that we need to pay? What are the upcoming payroll costs that we have? What are the supplies we need to pay? Rent, or if you're lucky enough to own, what is your mortgage? Another critical thing is we need to understand when money moves. And when I say that, let me unpack a little bit further. The timing of the payments absolutely matter. And when I say that, I'm thinking immediately about what are accounts receivable and accounts payable. So as an example, it may end up being that your accounts receivable have a 90-day span. And to say that slightly differently, you may, as a business, allow your customers to pay you in a period up to, say, 60 days. Whereas your accounts payable, these are funds that you owe someone else. It may be that those vendors only allow you to pay them in a period not to exceed 30 days. Clearly, just basic math, there's a delta, right, between the 60 days and the 30 days. So timing matters. We'll spend more time on that, but that will be a theme that definitely continues throughout today's discussion. Let's break down some of the red flags as it relates to cash flow. If you're waiting for money to come in before you can pay your bills, then your cash flow needs attention. And again, it may not be the AR versus the AP scenario that I just mentioned, but if you're struggling and if you find yourself waiting, then it's time to throw a red flag and dig a little bit deeper. Next, the second area that we would focus on or suggest everyone focus on is your debt levels. And just like personal credit cards, which can amass large balances really quickly, we all have to watch our business debts just as careful and monitor those because they, like, again, our personal credit cards, they can escalate really quickly. And in a blink of an eye, well, maybe we find ourselves in a position where we owe more than we thought that we did. So to follow that same theme, let's unpack a couple of things of what to track. And let's start with what you owe to your term lenders. And if that is a new term to you, let me unpack that. When I say term lenders, really what I'm referring to is lenders that you pay a fixed amount to every month. So say, for an example, if you have a vehicle loan for your company and your monthly payment is, and I'm just making this up, $500, that's a great example of a term loan. Other things to track, just generally speaking, the payments to everyone. And that builds on the next item, which is credit cards. Track not only the payments, but track the balances. And ideally, those credit cards should be paid in full every single month. And I recognize that that's not always going to happen, but it should, right? That should be the goal. And then the other thing that I've noted here is just something that we see all the time as a lender when we're working with small businesses. Lots of times business owners have loaned money to the business, but it's never tracked and it doesn't really show up. And just like any lender that might lend money to you, they're tracking those details. And so don't sell yourself short. Or to say that slightly differently, if you are owed money by your business, make sure that that shows up. Make sure that you can quantify the amount that's owed, even if it doesn't have any specific terms of repayment. And then the last item here, how much debt you have compared to what your business owns. That might be a new term. And honestly, it maybe has never been on your radar until today, but it's on every lender's radar. And it's something that lenders look at incredibly closely. So to give everyone an idea of debt to equity as a ratio, I mean, most people are looking, or most lenders are looking at a ratio of like 1 to 2. Lower is great, but anything above a 2 typically signals that the business isn't overly healthy. And so that's a worthwhile thing to look at. And I mentioned we as lenders look at it. I'm not suggesting that everyone out there has to be a nerdy lender like myself, but most businesses interact with lenders. And so we share some of this just to give you an idea of what it is that lenders are looking at when they're, taking the temperature or the pulse of your company. In terms of red flags, let's cover these one by one. Using credit cards for everyday expenses, but then not paying them off. I'd mentioned that before. I recognize that, again, in a perfect world, you're going to pay them off. And there might be months, just to be totally candid, where you know that there's payment coming and you just need to carry those credit cards for a couple months. That's okay periodically, but don't let that exception become your norm. Making minimum only payments on loans. I would say that's a red flag. That's not only unique to credit cards, but if you have, and going back to the hypothetical term loan scenario I talked about a moment ago, if your monthly payment is $500 and you can make a little bit more, then I would suggest doing that. And we can unpack that later in the Q&A session or part of this today's conversation. One, taking on new loans to pay old ones. And here, friends, it's kind of like playing that game musical chairs that maybe many of us played as kids. At some point, the music's going to stop. And when the music stops, there won't be any chairs left. And ultimately, that leads to the last item under red flags here on this screen, which is missing loan payments. And that's the biggest red flag. Before we go forward, though, I just want to say one more thing here. Before we go forward, I want to mention something that's related to debt and just this general theme. Throughout my career, I have been known to say that good debt unlocks business growth. I was sloppy in saying that, so let me say it again. Good debt unlocks business growth. So if your debt is mounting and there's no growth, you might throw a red flag and unpack a little bit of the reason behind your debt and why it's not helping you to grow. So good debt grows. Up next, profitability. Profitability tells you if your business is truly making money. And when I say truly making money, it's truly making money after all expenses have been covered. And before I jump into the weeds, don't confuse revenue with profitability. It's pretty common that our team will hear, "Oh, well, I have great revenues," and that's awesome. Profitability is really what matters most. And let me unpack that a little bit further here. So obviously, revenues can lead to profits, so tracking them makes absolute sense. So do that. Cost of goods sold or the cost of goods or your services, these can vary dramatically, and that's okay. So for what are goods-based businesses, the cost of goods it's generally much higher than for what we would know as a service-based business. Despite the variations, again, whether it's a high amount or a low amount, tracking this is critical and it matters a whole lot. And now I start to think about our own personal checkups. I stand on the scale, I know what I weigh. I get measured, I know how tall I am. What are some of the numbers for our businesses? And these all lead to numbers. And for every business, it's gonna be different. I happen to be a tall person, and so I know relative to my height, roughly what a good weight is. Other businesses, now comparing a human to a business, other businesses are, it's not going to be the same. Not every business is going to be incredibly tall or super duper short. What matters is you track these numbers for your own business and that you don't just do it once, but then you start to track over time and compare. And I'll start to unpack that as we dig deeper. So up next is your operating expenses. And when I say operating expenses, I'm referring to costs incurred through just your normal business operations. And then the next two items here that are fantastic numbers. In fact, I would even say they're both critical in terms of the metrics and what they provide. while they both say profit margin, the gross and the net are super duper different. So the gross, imagine the gross profit margin being what is the margin of profits that your company has after covering the direct costs. And that goes up to that cost of your goods or your services. Whereas the net profit margin, again, incredibly critical. People would argue that this might be the most critical measurement here. The net profit, that's after everything. So that's after all of the operating expenses are covered. And then other things. And specifically, I'd say things like paying yourself a salary. And that is the bottom line calculation that most lenders look at when we're saying, okay, here's revenue on the top. Here is your profits on the bottom. What is that margin? And again, it's going to be different for each business. If you're a manufacturer, that's going to look a whole lot different than if you're a salon. And I can give other scenarios. Again, yours is going to be different. There are some interesting industry averages that are out there. But the most important thing is to understand yours and understand where yours is going. And last but certainly not least is tracking your monthly and yearly profits. One of the things that you'll look at as you compare years and months is one, are you growing? And then two, you start to understand, is there seasonality in your business? So for example, it may end up being that you're busier, and again, I'm just making this up, but it may end up being that you're a little bit busier in the fourth quarter, or it may end up being that your business is focused on the summer, so the summer is your month. Also, as you look at year over year, you'll start to see some interesting trends. So for an example, it may end up being that you look at your business in 2020 and 2021, and everyone lived through COVID, and you see and experience what happened. And so you can see the impact of COVID and what that impact was on your business. So you zoom out when you look at the annual trends, you sort of zoom in when you look at maybe the monthly and the quarterly. And then to go back and to finalize a thought that I started, but let me finish pulling that thread for a second. As you look at these percentages, the profit margin or the numbers in general, take a look at them every single year. As lenders, when we are looking at a request for someone, we look at the hard numbers and then we look at those numbers as a percentage. So for an example, we're going to look at the cost of goods as a fixed number, and we're going to look at cost of goods as a percentage of revenue. And then we'll look at all of your operating expenses as we sort of go through your profit and loss statement. And then we're going to look at each of those expenses as a percentage, again, of revenue. And then ultimately, we're going to look at the gross profit margin and the net profit margin, and we're going to compare those year over year. So hopefully that's helpful as you're thinking about what do lenders look at. That's exactly what we're looking at. And I'm not trying to say that we're comparable to a health professional that would go in and give you a checkup, but essentially that's kind of what we're doing when we're reviewing a request for financing. So just as well learn to do some of those things on your own. Now, let's talk through some of the red flags here. Red flags, I think some of them go without saying. Profits decreasing while sales stay the same. That is a clear indication that it is time to reprice. Up next, not enough profit to pay yourself. When I look at entrepreneurs that abandon a business, it's typically because of this reason. They're able to maybe pay everyone else and provide a really a really amazing good or service, but at the end of the day, there's not enough money to pay them. And sometimes entrepreneurs embrace that and they say, okay, well, maybe this is more of a hobby than a business, and that's fine. Profit margins getting smaller, and deliberately I point that out. Sometimes that happens, right? There's fluctuations in the market. We're certainly living in a time where there's fluctuations in the market. But my big red flag moment here is don't wait until the profit margins disappear before making a change, including increasing your pricing. And last but certainly not least is I do hear this routinely where businesses will say, hey, there's plenty of sales, but we're still losing money. And that's where maybe the cost of goods or the services uh, really are not consistent with market. And so you need to make some adjustments. Area number 4, liquidity. And liquidity means having enough readily available cash to handle what are both regular bills and those unexpected things that just pop up. So again, when it comes to liquidity, here's what to track. Cash is king, as the saying goes. So track the cash in your bank accounts. Other things that you might want to track is just money that you can access quickly. That might be money in the cash register. That might be money that you have in transit. And when I say in transit, every once in a while, owners of the company, they have money. They need to go drop it off at the bank. It's at home. It's in a drawer. This is, again, money that you can access pretty quickly. And those are a couple scenarios of that. Upcoming bills and payments. So here, we're really going back to a few slides where we're talking about cash flow, specifically with a focus on the cash that's going out of a business. So as it relates to liquidity, just because you have money today doesn't mean you're going to have money tomorrow, specifically because other people are relying on you to pay them, normally to support their small business too. Emergency fund balance. Ideally, an emergency fund, people will say, and these are all opinions, but people routinely say it'd be ideal to have an emergency fund balance of 3 to 6 months. This sort of builds on the next one. Number of months you could cover expenses without new income. And it may end up being that you don't have any money set aside, an emergency fund or funds to cover your normal expenses without new income. So if the number today is 0 for either of those, then start by building a cash reserve. Man, you could start with $1, $10, but my suggestion is to start. And then last but certainly not least on this list is money. And these are funds that are not quite funds yet, but funds that would be converted into cash once you collect, or excuse me, I said that poorly. Once you send out the money that's owed from someone else. So as it relates to accounts payable and receivable, people owe you money, you owe people money. This is the movement of funds in and out that absolutely impact your liquidity. Now, there's a handful of warning signs here. Several of them tie back into the previous comments. Less than 2 months of expenses saved. Again, if your answer is today you've got 0, that's okay, but start. And I would say as a minimum, have 2 months. Routinely, when we're working with businesses that are growing and expanding, part of their expansion project, we'll actually look at having as a part of the request 2 months of cash on hand, just to make sure that as they're growing and expanding, they can weather whatever unexpected things come up. The no emergency fund, same thing as again. So I'm sort of repeating the same, but I'll echo, it's never too late to start saving. And then another warning sign is you have to delay the paying of your bills. That's always a red flag if you can't afford to pay people on time. It also tends to lead to distrust or lack of credibility with the vendors with whom you're working. And then last, this is definitely a big one, and it's you're not collecting your accounts receivable. It's one thing to make a sell, and I'm always happy and proud when a small business makes a sell, but it's an incredibly different thing to collect the funds from the sell. So to all businesses out there, develop practices and then follow them related to accounts receivable. And I think that many folks know this, but it's worth saying it out loud here. The older an account receivable, the harder it is to collect. then as you're struggling to collect with certain vendors, they may end up having some cash flow issues within their business. That's usually the reason that they're not paying. So reach out to them and ask them. I would strongly suggest that if you're not collecting, get the folks on the phone, stop by and their place of business and have a real honest and candid conversation, because their liquidity, as you see, directly impacts your liquidity. Is our fifth financial health area, and this is around assets. And so when I talk about assets, these are things that are of value to your business. These are things that your business owns, that your business uses, or in an event of liquidation that potentially your business could sell. And here I want to be mindful of a truth, and that truth is that many small businesses and medium-sized businesses, they don't have a ton of assets. So whether that's your story or you're a business that has a ton of assets, all of these are applicable. So assets, what to track? Track all of your equipment and machinery. One of the greatest things about tracking those items is that as you do so, you track those items on what is your balance sheet, and it has a direct impact on your profit and loss statement, because most equipment and most machinery can be depreciated. And that depreciation is a non-cash expense, so it reduces your actual tax liability without actually costing you any cash. Inventory. Inventory is an important one, and just beyond tracking the inventory, I would add track the age of your inventory, and I'll come back to that in a moment. Property, as it relates to property, I'm not referring to property that you rent. If you're tracking property that you rent, that's not your asset, that's someone else's. If you're fortunate enough to own property, that's the type of property that you should track. Vehicles, again, we're talking about cash being king. Cash is definitely an asset, so track that. And then money owed to you by customers. And here we go back to comments from a prior slide. And the money owed to you by customers, that is your accounts receivable showing up one more time. So this is not necessarily money right now, but it quickly converts to cash upon collection. Red flags now, red flags related to assets. You know, if you own a company and you have equipment that breaks down without replacement funds available, that's a red flag. And this is especially true if your business cannot operate without equipment or without that vehicle. And you see this routinely in smaller shops that say like a bakery, and there's one oven. You don't want to have that oven stop working and then not be able to generate revenues for the day. Or if you're in logistics and you're reliant on one or two vehicles, you need to make sure that if those vehicles have some maintenance issues, that you fix them quickly so that you don't rob yourself of the opportunity to have those assets out in the field, helping you to generate revenue. I said I'd come back to inventory. I'm doing so now here. Inventory sitting for long periods of time, that is a way that you just are having money tied up. And so it may need to be that you liquidate some of that, or honestly just get rid of it because there's a carrying cost. And the sad reality is that sometimes inventory can go obsolete. When I think of that, I think about how quickly phones change. And so there's plenty of phone cases out there that I have no idea where they're at, but I know that those go obsolete pretty quick. So keep an eye on the inventory. I'd said before, track how old it is. I think that's critical. If you're producing something for another product, again, like a phone cover is a wonderful one. Really stay on top of how trends are changing or emerging so that you can make sure that your inventory remains viable. And then assets losing value faster than expected. Every once in a while, you get talked into buying something. I say you, but any one of us gets talked into buying something, and it's like, yeah, that's a great idea. Then you purchase the asset and call it a piece of equipment. And then the equipment's not performing like expected, or it breaks down quite a bit. So a red flag is that, hey, you may see that this value or that the value of the equipment goes away very rapidly, and so you need to start saving for a replacement. So turn that red flag into something that's an action item. And again, update your budget and what you're saving accordingly. So we've covered right now or to date 5 things that you should regularly watch. Again, the business equivalent of a checkup. What we'll cover with the time that I have left is what you see on the screen, 6 different fixes for better financial health. And this is just an easy way for all of us to recap what we've talked about and then to go to action. So fix number 1, get your cash flow moving. You've got to build and keep a cash reserve. Again, start simple. Regularly review your business financials for runaway expenses. I can't overemphasize how important this is. It's easy if you're not keeping an eye on the financials, how quickly things can get away from you. And then calculate your business's operating cycle. And that goes back to the very first thing that we talked about, that cash flow. So you think you have, as an example, maybe you're buying an piece of inventory, or you're making one, and then you've got to sell that, and then you've got to collect. And then once you collect those funds, you can reinvest those funds back into either buying or building something else, and you rotate around. And I get that that's very goods focused, but on the service side, it's not very, very different. On the service side of the equation, you still need to sell your service, collect the funds, and then rotate that cash around. So tip number 1, fix number 1, get your money moving. Fix number 2, pay more than the minimum whenever possible. I said it before, I'll echo it again here now. I get that that's not always possible, but try. Next, look for lower interest rates. Rates during the pandemic were historically low. Coming out of the pandemic, they've been historically high. Rates will eventually come down. The Fed's just yesterday opted to keep rates where they're at. However, rates will come down, and when they do, if you have higher interest rate loans, it might be worth refinancing those or looking to see if your lender can make an adjustment to the existing rate. Next, only borrow for growth opportunities. I'd said it before, good debt unlocks growth. And then this is critical, and it's this idea of keeping business and personal credit separate. So if you have a personal credit card that you use for business purposes, and that happens, I don't personally love it, but I recognize that it happens all the time, make sure that that personal credit card is treated as though it's exclusively for the business. Don't go out, buy dinner for your family on a Friday night using it. Have it exclusively be for business uses, even though the card might be in just your name personally. Also, if you don't separate your business from your personal expenses, you may not accurately be assessing the health of your company. So just something to be aware of. And if you know that those two worlds are blended or blurred, then my strong suggestion would be to start unblurring those as a way to mature. Next is fix number 3 is boost your profits. So review and adjust your pricing. And this is always true. But right now in this economy, Allison hinted on that a little bit at the very beginning during the introduction. This is especially true. So review and adjust your pricing. I would watch pricing like a hawk right now, especially as there's some economic uncertainty. Next, track your inventory closely, and I won't repeat what's already been said, but that's key. And eliminate services that lose money. And the only way you're going to be able to do that is to really track what goods or services don't lead to a strong profit margin. And that really goes back to some of my prior comments. But here, as I was preparing for today, I started thinking about how in every economic season there are winners, and then there are folks that sometimes just don't win. And so I don't have it as another bullet, but just take a mental note of this. I think there's a real opportunity as it relates to boosting your profits to be incredibly creative during this economic cycle and look for and identify opportunities that can generate strong cash flow. So every one of you are entrepreneurs, go be entrepreneurial. 4, improve your liquidity. So start with something. If you look at this emergency fund jar that we see on the screen, there's at least a $10 bill in there. So we have Alexander Hamilton for the win. If you start there, that's fantastic. I would at least start. I would say an interesting thing is maintain good relationships with lenders. And that may seem counterintuitive to liquidity because ultimately lenders want to lend you money, but lenders might be able to provide and unlock opportunities for your business to access working capital, which ultimately helps your liquidity. I also tend to think that approvals with lenders start long before the application is ever even submitted. And I would say, take this pretty seriously. Character is probably one of the most important things that lenders look at. And so lenders are going to look and say, hey, is this person a person of integrity, and do I like working with them? And if the answer to that is yes, typically your lender is going to advocate on your behalf as they suggest that you move forward with a loan. It's not like Shark Tank. You don't come in and make a pitch that almost never happens except for on TV. So your voice ends up being translated through the voice of the lender with whom you work. And then obviously watch your payment timing. Just make sure that you're balancing accounts receivables and accounts payables. Fix number 5, protect your assets. So maintain your equipment. And when I say that, I think deferred maintenance can make smaller problems worse and oftentimes more expensive when it comes to the repair. So if you see something, try to address it sooner than later. Insure valuable assets. Every once in a while, I'm super just sad when I see devastation hit a small business and they just let their insurance lapse. It happens more than you would know, and it's so sad to see that a large disaster really results in financial ruin because of uninsured assets. So obtain insurance, maintain your insurance. And I've mentioned this before, so I'll echo it one last time here. Don't let your inventory get old. Easier said than done. Make good habits, track your inventory, don't let it go old. And the last tip is build financial or strong financial habits. Review your numbers. And if you don't feel like you're a math wizard, you don't have to be. You really don't have to be. You just need to build that habit, that muscle memory of looking at and taking ownership of your financials. So my invitation is to do it. And if you have someone else that's doing it, don't just delegate that to them. You got to check in. And one of the things that we routinely see in small businesses is that sometimes a bookkeeper or an accountant sort of runs away with some things, and then the business owner is not given the opportunity to see fully what's happening within the company. Or worse, every once in a while, a bookkeeper or an accountant maybe they're taking a little bit of money off the top. So build some of those financial habits, keep yourself accountable, and the people that work with your numbers accountable to doing good things with those numbers. And friends, we carved out 45 minutes, and we're to the point where we would love to be able to stay in contact. As Allison said, we'll share the recording of this with you. We hope that some of the tips, some of the tricks that we shared are fantastic, but I'll pause there, and I think we have a couple minutes available for questions.
Perfect. So just remind folks that they can put their questions in chat or question and answer. I'll be watching those. I do have a couple that have come through. Brian, this business was wondering how they could keep their personal and business expenses separate if I used a personal credit or funds to launch my business.
Yeah, I think maybe I touched on that just a little bit earlier. I get that sometimes we have a personal debt that funds the business. There's no great answer here. The reality of it is that that debt is with you personally, but you can have that debt show up on your company balance sheet. And the way that it shows up is that that debt that you owe would then be owed to you by your business. So have that debt reflect as a debt to you that you then know that you owe to someone else. And to unpack that a little bit further, like, credit cards, like, that's probably the number one thing that we see people use credit cards on behalf of a business. I gave a tip before, I'll echo it again here now. If you have a personal credit card that you use for business purposes, then use it exclusively for business purposes. Keep all of your business expenses on that card and then use a separate and distinct account for your personal. And it's the easiest way to set yourself up for success. And then the next time that you go to get a loan, ensure that that is under the business name. And to just stand back, I recognize that may not be the easiest thing for everyone, but observe this the simple tip. If you don't obtain credit in your business's name, then you're really robbing your business of the chance to build credit. And I wouldn't do that, especially when your business needs smaller tranches of cash. If you can repay 25,000, 50,000, 100,000, then it makes it easier as your business grows to go to a bank to ask for much larger amounts. What other questions might there be?
Great. And do you recommend building a cash reserve or paying down high cost debt if funds are limited?
Well, that is a great question. I recognize that the answer can't be yes to both. If you have high interest debt, you've heard of the snowball effect. Do what you can to pay down loans as fast as you can. The balance here, which is an interesting balancing effort, is that you need to have some cash on hand. Once you've paid back a lender, that money's not, it's not yours anymore, right? The principal balance of the loan has been diminished. And so ultimately, it makes the most sense to build up a little bit of a nest egg just so you have it and you have greater control over those funds. And then once you build up enough of a nest egg, then I would look at making larger payments to reduce your high interest debt. We might have time for one more question, it looks like.
Okay. Let's do one more. How much should a small business aim to keep in an emergency fund? Is there an industry standard percentage of monthly expenses that you would recommend?
So I think it goes back to this idea of like tall versus short, and every business is going to be different. So in terms of industry, there might be some specifics. I don't have the expertise to be able to answer that specific by industry, but I think just a general good rule of thumb is start by saving up 1 month.
Mhm.
That's start there and cover all of your expenses, but specifically your operating expenses. Make sure that you don't have to furlough any of your employees. Make sure you can pay your rent, right? The critical things that keep your business operating, and then move into 2 months. I think the gold standard is to have 6 months, and that feels overwhelming for most people. It feels overwhelming to many of us, right, on the personal side of the house. So I get that it would on behalf of businesses, but start with at least a month, grow from there. That would be my response.
Great. I think we're at time, so we'll follow up tomorrow with an email of this recording. And here's Brian's contact information if there's any other follow-up questions. Otherwise, we'll say bye for now.
Thank you, everyone. Again, appreciate your participation. Be well.
Bye.